Hello traders, Gary Wagner here. Approximately 11 a.m. in Honolulu, 5 o'clock in New York City. It is Friday, finally, the 3rd day of August 2012, and this is the daily report for gold and silver. Following the release of a jobs report, we'll get into the detail in a second, we have moderately to sharply higher prices in the precious metals, currently trading up about $13 to $15 higher on the day, 1602.95. You can see current cash print in gold with a low 1584 and a high of 1608. Now the move in gold was almost a 1% price gain on the day. Not to be outdone by gold, we have silver almost 2.5% higher, up 67 cents currently. As you can see, current print on the board 27.73 with a high of 28.06 and a low of 26.96. Traders, following 3 days of price declines in the gold market, daily chart that we're currently looking at, and you can see the 3-day price decline right here. We had the release of our jobs report. The expectation was about 100,000 new jobs would be added, when in fact it was about 163,000 new jobs were added. At the same time, our unemployment rate went from 8.2 to 8.3. Not really a mixed bag, as much as lower expectations than what we saw coming in. On a technical basis, there can be no doubt. We have seen this resistance area of around 1630. That has been holding throughout the month of June, throughout the month of July, and as we go into August, we have had our first testing right at the end of July. Market came down, and as you can see, we've recovered quite nicely, and we are back over $1,600 per ounce of gold. You know, traders, the correction that we are currently experiencing in the gold market is one that's almost unprecedented. And when I say unprecedented, I'm really talking about time parameters, how much time it has taken. Because realize that since 2008, this market's been pretty much a straight runaway train to the upside. Now, of course, it has hit tops, and from those tops it has corrected, as you can see right in here. But for the most part, the correction in terms of the time span it took to correct and then start moving up has been fairly short term. And when I say short term, I mean short term compared to the amount of time we're looking at right now. Because as you can see, this market, this is July, of course, of last year. This is the beginning of what I call our July rally. Market really takes off parabolically up until about September. Then from September, we can honestly say we are still in this corrective period. Now, we have had a series of lower highs. At the same time, we have had a series of higher lows. That's that compression triangle. But when you look at the sheer distance, we are talking about really 1 year later from the beginning of this huge rally. Here we are, we have just passed July, and the market is still trading relatively under pressure, and it has certainly not even gone to a test or take out the all-time record high, that 1902, but even this 1802 has been pretty much unpassable, as you can see with these two tops in here. Rather, what we have seen is a market that can be really best defined by a pretty tight trading range. The trading range began at around 1520. You can see that's these series of lows right here. Right now we're at about 1530. As the compression triangle creates higher lows, of course, this will still touch the line, but at the same time, we are getting lows that are off these previous lows. But at the same time, we've got this really incredibly strong band of resistance sitting at around 1630. And you can see how many times literally the market has tested that area with the inability to really pop or trade above it. My daily traders are, of course, aware of the fact that we entered a position roughly at 1578, and then we pulled profits by trailing our stop up a few days ago, got out just under $1,600. Market is $2-3 above that point. And my sentiment is this: with the kind of activity that we saw, with the markets under pressure the way that they were, there is no doubt in my mind that at least for the time being, even in a tight range, we were able to pull some profits out of the market, both in gold and in silver. Now, the fact that the market is a little bit above the point we got in isn't really something that troubles me. It would trouble me, of course, much more had we taken a loss on that trade. And to me, preservation of capital is absolutely as important, if not more important, than being able to add to that capital. In other words, making money. Making money is one thing. Holding on to that money, I believe, is of critical importance in the long term. As we look at this chart, again, it's a daily chart, cash market of gold. Once again, we are really approaching the apex of this compression triangle. And at the same time, the range that we have has been truly contracting and compressing to a point where now we have really, really strong resistance at about 16, call it 1630 to 1635. You can see that right in here, these series of tops. We have had a series of higher lows at the same time. To me, as we approach this apex, it tells me that there is an increased probability, and it's not essential, it's not etched in stone, but an increased probability that we will get a sizable breakout in terms of the energy being released as we get to the apex. And of course, that can be to the upside or to the downside. It is also looking like a bearish wedge, but at the same time, within our Elliott wave count, if that count's correct and if gold follows this count, because quite honestly, you can see this type of correction has been very, very difficult to keep within that count. But if it does, we would expect that breakout to be to the upside. We will just have to wait and see. The answer is not evident just yet. As far as silver goes, silver, my personal belief has been that there is people out there making a play for that market right now. We saw really, really strong support, $26. There's no doubt. You can see that in terms of this real strong, I believe, triple bottom right in here. You can see the fact that it has been tested on a number of occasions, and it also has been coming off of that particular low with a vengeance. When we go ahead and blow this chart up, let me go ahead 1 second. If you recall, my daily viewers will, that I talked about the fact that even though there wasn't what's called a true price gap because you had the high here and the low here, you did have the fact that these bodies were separated with some distance in terms of a price void. And that's why I said yesterday, it wouldn't surprise me at all to see this gap immediately come and get filled. We saw that gap get filled in a 1 day time parameter since I made that statement. You can see how well and eloquently it has bounced off of these lows. You can see the kind of strength that we have in this market. And let's go ahead and convert that to a Heikin-Ashi. And as you can see on the Heikin-Ashi, we have gone to a doji candle. And typically you have to realize that these Heikin-Ashis, without a doubt, are lagging indicators. So we've got a doji candle in there. It hasn't gone green, although it has gone green when we look at the intraday Heikin-Ashi, whether it's 240 or 360 minute, we do get a pretty strong green signal moving up. We'll look to reposition ourselves in the market beginning of next week. We'll have to see how and what kind of carry through we get over the weekend. I can tell you this, with the way the market bounced off both in gold and silver, it wouldn't surprise me to see higher prices next week. The question still remains that really strong resistance at 1630. Until we see the market take that out or take out the lows, we are still bound within this tight consolidating trading range. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.